Welcome to Wealth Roadmap with Jeff and Steve, your guide to simplifying wealth management. Join us as we explore financial planning, taxes, investments, insurance, and legal frameworks to help you secure your financial future. My name is Jeff Costello. I'm here with Steve Bene, and welcome to episode 9 of the Wealth Roadmap. Okay.
9 it is.
Yeah. Wow. Time flies by when you're having fun.
And that's all we do. Having
Steve,
fun.
Should I go with the glasses? Does it make me sound smarter or look smarter?
Are those prescription? I never knew you wore glasses.
Today we're going to talk about the 4% rule. What is the 4% rule? Well, one of probably the biggest concerns that pre-retirees or retirees have is running out of money. And so Steve's going to get into the specifics, but basically there's been a lot of doctors and fancy PhD, a lot of people that are way smarter than Jeff Costello basically came up to say, hey, if you withdraw 4%, you should be safe and you shouldn't really worry about running out of money. Now, of course, everyone's situation is different. So maybe this applies to you, maybe it doesn't. But, we talked about this kind of creating, about the bucket plan. And when it comes to sequence of return risk, now people rely on their 401k, their retirement assets in retirement. Whereas, years and years ago, people had a pension. They didn't have to worry about running out of money because that pension always hit on the first of the month. But now with pensions kind of being a thing of the past and people now having 401ks or investment accounts or whatever it might be, you need to make sure that whatever you pull out of these accounts is going to be enough to pay your bills, right? Afford you the lifestyle and retirement that you want, but at the same time, not have you run out of money and having to go work at a restaurant or, be a door greeter or anything like that. In creating working income. So, Steve, talk to us about where the 4% rule came from.
Yeah. So, for those that know where it came from, I apologize for this being repetitive, but back in the 90s, Bill Bengen was a financial advisor, and he pretty much kind of developed this, came up with this, and more or less said, tested this and basically came up with that if you withdraw 4% of your retirement portfolio in that first year of retirement, adjust the amount annually for inflation. It's designed to make sure that a retiree's savings can last through a 30-year retirement, right? A very high probability of lasting through that 30-year retirement. And so that 4% rule, it's a guide. Somewhat of a guide. We hear a lot about it. Since then, we'll talk more about this, but there's a lot of changing landscapes, economical, market, I should not say economic and market changes that may or may not allow that 4% to be feasible or to be a strategy that is a reliable strategy. And I think the biggest thing here is because at the end of the day, right, when we're working, we're saving, we're taking our income and turning into assets. It's easy. We're saving, we're accumulating wealth. We've talked about that before. But then when you get to retirement, all of a sudden you have to take the assets that you have and turn it into income. And this 4% rule, again, which is probably the more common strategy that we hear, it essentially helps you take those assets and turn that into income. Very simple. Hey, if I take 4% of my assets and I have a 30-year period of retirement, I have a pretty high probability, 98, 99% chance of not running out of money. And so it can definitely work. It's a straightforward approach to navigating that post-work life world, that retirement world that we end up being in. But I think that, there's some pros and there's some cons, just like everything else, right? And Jeff, just as we were talking about this, kind of talking through some of those challenges with that 4% rule. What do you think that the biggest challenge is?
I think the biggest challenge that we're seeing today is the increased longevity, right? You mentioned, back when this was kind of developed in the 90s, people weren't living as long as they are today. And we're seeing that with also a big struggle with what Social Security is going through. People are living longer than expected, and so yeah, I mean, you can draw 4% out of your account, but for how long? And so we'll
Yeah.
go into kind of the newer perspectives on what that new percentage should be. But I think right now, increased longevity is a pretty big challenge um that's tough for that 4% rule.
Yeah, I think so too. And like you said, I mean, look, with the 4% rule, that's for a 30-year retirement. But if you retire earlier, or if you have a longer than average life expectancy, that's where you could get into some trouble.
Yeah, that's where all the probability of possibly running out of money, right, creeps up. So, yeah, it could vary for everyone.
Agreed. What about the another one we're talking about, right? The lower than expected market returns. Talk a little
Yeah,
bit about that one.
yeah. So lower expected market returns, right, depending on what you expect to get from your portfolio. Just just like the overall financial uncertainties with what's going on, especially with interest rates, right? Just like 2 years ago, 3 years ago, interest rates were significantly lower than where they are today at the recording of this podcast. So going forward, what is that going to look like? You know,
Yeah.
I think that's a big factor that goes into it, because what are you going to get when it comes to your safe money?
Yeah. No, agreed. And the other thing too, just conceptually thinking about that, right? It's like, okay, and everyone's situation is different, and that's key. But just to do round numbers, if the rule is 4%, and you have $1 million, right, or 2 million, we'll start whatever the number is. I'm just making numbers easy. $1 million, it could be 2, 3, 4, 10 million. Obviously, the more assets you have, I think the easier it would be to rely on the 4% rule, depending on the lifestyle that you want to live. But on $1 million, that's what, $40,000 a year that you would be able to live on. And so, we're in the tri-state area, specifically New Jersey. $40,000 a year could be a bit challenging. And yes, there's Social Security and there's pensions, but I think that's where, when you look at it, and from a standpoint of is this a viable strategy, really what it's going to come down to is what you want your lifestyle to be in retirement, expenses that you have in retirement, other forms of income that you may have, whether it's Social Security, pension, rental income, to determine whether or not a 4% rule could benefit you. And I think that is the key piece here, because at the end of the day, if you have $1 million or 2 million and you have other sources of income and you can kind of maintain that lifestyle, maybe that would be a viable strategy. But on the flip side, if you need a little bit more income, that might be where you might find some challenge with that 4% rule.
Yeah, and that kind of like brings us into like the criticisms of that 4% rule. And the other thing is, hey, we're going to take a 4% every year for the rest of our life. And again, it's adjusted for inflation and whatnot. But we just did this the last episode with RMDs. It
Great
starts
point.
off around 4%, but I think, what is it, when you're 90, it's at like a 10% RMD, meaning that if you have $1 million in your 401k at 90 years old, you have to take, the government forces you to take out 10%.
Roughly,
Right?
yeah, roughly
Yeah.
about, but could be a little less, but at the end, but correct. That's right. Great point. It's like, well, wait a minute, that 4% rule kind of goes out the window. And if a lot of your assets are sitting in these tax deferred retirement accounts that are taxable, and that taxable at distribution, and are required to have a required minimum distribution, well, then you got to kind of shift and look at, all right, well, I'm going to be forced to take out more than 4%. So again, squashes that altogether, right? Because you've done such a great job, you saved. We meet a lot of people who are in that situation where they've grown their wealth in these retirement accounts, and now it's what Ed Slott. For those of you who don't know who Ed Slott is, he was coined by, I believe it was Wall Street Journal, America's IRA distribution expert. He's a CPA. He focuses really on kind of the taxes in retirement. He has a book out with in that name. I believe that is the name of the book. But regardless, you can look it up for yourself. If I have the name of the book wrong, forgive me. But at the end of the day, what he calls it is a ticking tax time bomb. And so, not only is it a ticking tax time bomb, but it also can, because of the rules around it, it can really alter a distribution or withdrawal strategy that you have if you don't plan properly, because you're forced to take out more, even if you don't need it, right? And so great. That's a great point on that one too.
Yeah, and I think again, the 4% rule doesn't apply to everyone. It's there's no one size fits all approach to retirement. Everyone's social security benefit is different. Everyone's lifestyle is different. Some people may have a mortgage going into retirement. Some people may not have a mortgage. I think that's a big criticism when it comes to the 4% rule.
Yeah, I would agree. And we keep talking about the 4% rule, right, Jeff? But it could be based on, as you mentioned earlier, I'll call them scholars, right? The people who are a lot smarter than us over here. Some of them say, that 4% rule in the past, when Bill Bengen had done the research, it really only had market data up to the 1980s, and a lot of things have changed since the 1980s. And so because of that 4% rule, some scholars say could be closer to 3. There's others that even say could be closer to 2.4%. And 2.4% might be a bit low, but here's the bottom line. I think this just shows you what is the right withdrawal rate, right? You have, Bill Bengen saying 4%. Now, newer research is coming out by the people who are, again, doing the research, like Bill Bengen did, back during that time, during the 80s, or maybe a little beforehand. And so the question becomes, is it 4? Is it 3? Is it 2.4? It just adds more uncertainty. And so one thing that we know with that 4% rule is it isn't guaranteed, or that whatever rule it is, it's not guaranteed. It isn't something, whatever amount that you pull out, yeah, there's a high chance that it's going to work, but there are things that could come in the way, which could really kind of, push you off the path to what you were hoping was going to be the retirement of your dreams, right? The retirement that you wanted, that you planned for. And I think that's where, just looking at it from the questions that we get about it, is it comes right back down to there's a lot of different thoughts on the topic. We don't really know what's right. And that's where planning comes into play, and using a proper tax efficient drawdown strategy, whether it's a combination of a few different strategies, whether it's, using, part of that kind of I'll call it the 4% rule, with other types of strategies to help, maybe provide a little more guarantees, so that that you can maintain that lifestyle.
Yeah, I mean, if you're going to withdraw 4%, that's all well and good. But if there's a lot of market volatility, or that sequence of return risks that we talked about in past episodes, again, you're kind of burning the candle at both ends there, and that'll, significantly increase your probability of running out of money a lot sooner in retirement than you may think. And, again, you taking out 4% or 2.4 or 3%, whatever the number is, it's really going to come down to in the first 2 years of retirement, which is like kind of what we talk about in that sequence of return episode.
Yeah. And just think about it. 2008, COVID, 2022. It's just, again, if something happens and the markets are down and you decide to retire, two things. One, are you going to really want to take out that 4%? Like psychologically, when you look at that, you might have that an emotional kind of response to saying, I don't know if I want to really take money out now. The markets just pull money out. I'm taking it out. So, just from an emotional standpoint too, not even looking at numbers, it's something that you have to make sure that you plan for. So yeah, the sequence of returns risk is a big one. And going back to that episode that we talked about with how it can impact it, I think that definitely does impact the 4% rule.
Yeah, and think about that emotional part, right? So if you're in your, I don't know, 60s, late 60s, early 70s, and you're like, I don't want to take the money out. I don't want to take out my 4%. I'll push it off. Well, now you're pushing off your go-go years of retirement, right? You can't get that back. This
Right.
is, and at the flip side, if you're in your 70s, you have to pull, or in your late 70s, you have to pull out that money, assuming that the money's in your retirement account and you have to take out RMDs. So yeah, like there's that emotional element of, hey, I'm not gonna take the money because the market's down. It's either you're giving up the best years of your retirement where you can travel, you can do all these different things, but because you didn't plan properly, you're gonna forego those bucket list vacations or those bucket list trips. I mean it's and that's again, it kind of goes back to our first episode where if you have a plan, you could set yourself up for a lot more success where you increase your chances of running out of money in retirement.
Yeah, like especially when you have 4%, let's call it 3 or 4%. You have the money that you're holding, right? Here's the other thing. What happens, Jeff, if, again, let's use numbers that are easy, $1 million, right? 40,000, you say, okay, great. $40,000, I could work with that. You have the $1 million. Again, it could be $1 million, 5, 10, 20, concept's the same. What happens if you need additional money or you need to dip into the principal? All right, so now you got $1 million, but you say, you know what? I got to take an extra $20,000. Took a couple trips, so one year you take out, you need to take out $60,000. What happens to that $1 million?
Yeah, you're gonna get crushed.
Yeah, right. So you have to pull money out. You have to take if you still have the $1 million, right? Depending on where the market is, but you're not now kind of living on that 4%. You might be eating into that principal. You might now dip into that. So if you dip into what you have now, maybe you have a little less. Well, if you have a little less, that 4% rule, right? We're not starting off $1 million. It's less. So you're either going to have an increased withdrawal rate now because you have less money, which could then dramatically, increase the probability of running out of money. And there are a lot of these Monte Carlo simulations or calculators out there. Feel free to just Google it and just play around with it just to see the impact of what happens when you change that from 4 to 5 to 6%. And you'll see the probability of running out of money, exponentially increases. So that's the first thing. Or, you say, okay, well, if I continue to take that $60,000 out each and every year, you now are in a position where that rule has kind of gone out the window. All right. And so it's kind of like holding that money hostage, so to speak. And that strategy is very rigid. There's no room to be able to pivot. There's no room to be flexible, especially with changing lifestyles in retirement, or especially if as we know, life happens. If we need more income one year or if something happens, there's no way to really adapt to that without putting a little more stress on the assets that you have. So I think that's another thing just to keep in mind with that. Again, everyone's situation is different, but that's where you really want to just look at the full picture, because you don't want to be in a position down the road where you put more stress on the assets, by pulling more money out.
Yeah, and to your point, there's so many calculators out there. There's so much information out there on the 4% rule. There's so many experts that have different opinions on it. But at the end of the day, it's trying to figure out what's going to be relative to you so that you don't run out of money, right? And so creating that plan, so whether you're following the 4% rule or whatever the case might be, that you're not putting yourself in harm's way when it comes to retirement planning.
Yeah. Yeah, and just kind of going back to that example that I gave, right? I don't know if just to be clear, if you take out more money than that 40,000, okay, now you have a higher percentage distribution rate, right? That's $1 million. I take out 40,000, but let's just say take out another 20,000. Again, very high level. Now you have less than $1 million. So make it another 100,000. Now you have 900,000. All right. Well, now 40,000 and 900,000 is higher than 4%, or you have to go back down to 4%. Now 4% of 900,000 isn't giving you that 40,000, right? So again, that's just to clarify. I want to make sure that I clarify that. That's what I mean. There's kind of a lot of room for error on that with that strategy.
Yep. Yeah, I mean the 4% rule. There's really it's pretty self-explanatory, I guess. I mean, I don't know. I say that for us. Obviously, we've been doing this for so long, but again, all these scholars, like Steve mentioned, are coming out saying, "Hey, you should be withdrawing anywhere from 2.4 to 4%, 3%, whatever the number is." Yeah, you have a bigger chance of not running out of money, right? But I mean, I don't know, Steve. Is there anything else that you want to?
No, just to, for some alternative, solutions and strategies, when you're putting together a distribution plan, especially now because rates are higher, there could be, typically what we say is there's three or four approaches, right? You could certainly use that 4% rule, taking that whatever rule, 3-4% rule. There's kind of a drawdown strategy where, going back to our bucket plan philosophy, where kind of you segment your money based on time and purpose, and you allow for having a now bucket for your emergency savings, a soon bucket, and that later bucket. So that soon bucket really is meant for years, if you're just starting to retire, years 2 through 10-ish, 10 plus, depending on growth of that soon bucket. So, you preserve a portion of your assets in that soon bucket to rely on for the first 10 years. Now that allows the rest of your money to be put in the later bucket. And if your risk tolerance, or if you feel comfortable with a risk for that later bucket to be a little more aggressive, this approach or strategy allows you to do so, because with the now and soon bucket, you bought a time horizon. You can now invest the rest of your money that you have in the later bucket for growth. And so instead of kind of having all your money being used for that 4% distribution rule, now it's more segmented. It's you're looking at a bucketed approach, and that you can grow some of those assets without having to touch them, because you have a time horizon in that now and the soon bucket. So, I would say, a drawdown approach is another strategy, a guaranteed type of approach as well. And there's really kind of three ways to guarantee. You either use a bank savings account, right, or a CD. You potentially use treasury bonds, or you use an insurance carrier. Those really, in the world of retirement planning, we always say there's a finite amount of retirement income planning strategies. It's not like we can kind of make up these wonderful strategies that no one else has access to. No, there's a bunch out there, but we know that there's what they are and how they work and how they operate. That's if you're looking for guarantees, that's how you do it. And maybe we discuss that on another episode, but guaranteeing a portion so that you have that income coming to you, again, depending on how you do it. And that works not for everybody, but it could work for a portion, so that you can add that source of guaranteed income with the Social Security that you have, with the pension, and you're preserving a portion of that money. You're not using all of it, but you're strategically utilizing these types of guarantees to be able to provide you that guaranteed income in retirement. So we have kind of that draw. So we have the guarantee, income wise. You have the drawdown strategy. You also have a yield approach, and the yield approach now, with interest rates being a little higher than they have been, it is a little more attractive. And if structured properly, there are strategies that can, provide an income, whether it's using a portfolio, a dividend yield portfolio, a short or intermediate bond portfolio. Even you could even look at a municipal bond portfolio, depending on the type of money that you have. And, we would recommend that more so in a non-retirement account, just due to the tax benefits, because the interest on these municipal bonds, if the proper municipal bonds are used, are both state and income tax free. So that as a strategy, just looking at, we had set this one up. Jeff and I had a client, and they were in a position, not to get into the details, but we were able to set up for their soon bucket a portfolio that had a dividend yield of a little over 5%. Now that's subject to change, of course, and that's something that we always have to review. But just looking at that from a standpoint, again, off $1 million, well, two things here. Now that 5%, that's the dividend. We're not touching the principal at all, and we can now use that and allow the principal just to kind of remain. And, that principal over time, if markets do well, and time is one thing that we want, and when trying to have growth in our accounts, then that principal could continue to increase as well. There could be volatility, but the point is, now, instead of relying on this 4% or 3% rule, again, you position a portion of your assets, use what's available to you, and structure it the right way, implement it the right way, and you might be better off, or you might be in a better off situation. Or maybe you blend them all together. I think that's the key, is that don't be pigeonholed to just one strategy. Really look at your situation, expenses, what type of lifestyle you want to live, what type of income that you have, and create a plan using the strategies that you have available.
Yeah, I think that's like the biggest thing here, is that the one size fits all approach is just not a great way to look at retirement. Just because your neighbor, your friend, your brother did something doesn't mean that it's going to work or make sense for you. So you want to make sure that your plan is going to adapt to that. Yeah. So I think that kind of like wraps it up.
I mean, what more can we say?
Yeah. Again, so to conclude, right? Again, there's a big debate when it comes to like all these different financial experts, right? From Wade Pfau to, Michael Fink there's a lot of different scholars out there. And again, you can Google 4% rule, and you're going to have one article telling you one thing and another article telling you the next. So the one, you just got to, see which one's going to kind of sit right with you. But, again, goes back to our planning. Make sure to see what your plan looks like, and, kind of go over those different what if scenarios. Like, again, what if the market does crash? What if interest rates go down? What if inflation goes up? Because again, the 4% rule, it's going off historical data, right? So, again, and that's kind of goes into the importance of, creating a personal retirement plan, not a one size fits all. And then again, tuning into the next episode to see, what the next concern might be for retirement. But again, running out of money is, I feel like, one of the biggest ones that we hear. And a 4% rule is something that's usually brought up. So we hope this was helpful in trying to educate you on what is that 4% rule.
Yeah, and of course, if there's questions, just please let us know. But other than that, I think that covers it, Jeff. I got nothing else other than what we just talked about.
Listen, everyone enjoy the rest of your day. And remember, if you have any podcast suggestions or would like to hear about certain topics, feel free to reach out. Otherwise, like, subscribe, and all that fancy podcast stuff. And we'll see you on the next episode. Bye, guys. Thank you for joining us. If you enjoyed our podcast, don't forget to like, subscribe, and leave a comment on topics you'd like for us to cover on future episodes. We'll see you soon.
Financial planning and advisory services are offered through Prosperity Capital Advisors, PCA, an SEC-registered investment advisor with its principal place of business in the state of Ohio. One Team Financial LLC and PCA are separate, non-affiliated entities. PCA does not provide tax or legal advice. Insurance and tax services offered through One Team Financial LLC are not affiliated with PCA. Information received from this video should not be viewed as individual investment advice. Product discussions and illustrations are hypothetical in nature and will vary based on many factors, including but not limited to age, health, product, insurance carrier, and product design. You should consult the insurance carrier website and policy for detailed information. Content may have been created by a third party and was not written or created by a PCA-affiliated advisor and does not represent the views and opinions of PCA or its subsidiaries. For information pertaining to the registration status of PCA, please contact the firm or refer to the Investment Advisor Public Disclosure website. For additional information about PCA, including fees and services, send for our disclosure statement as set forth on Form ADV from PCA using the contact information herein. Please read the disclosure statement carefully before you invest or send money.